there's two things always happening in every sale of a business, right? One is the price, but the other is the go, no go decision that gets made.
Welcome to the Measure Success podcast, where we feature top leaders on how they measure success in their business and life. Now, let's learn from their experiences.
Carl J. Cox here. I'm the host of the Measure Success podcast, where we talk with top leaders about effective strategies that inspire success. This episode is brought to you by 40 Strategy. 40 Strategy is designed to make strategy work for small to medium-sized businesses and organizations, but not only helping them design a strategic plan, but more importantly, keeping them accountable to actually get it done. To learn more, go to 40strategy.com. We also encourage you to go out and buy our new book, Lost at CEO, An Entrepreneur's Guide to Strategy. It is a great way, a fable to help understand and learn there is a better way. And so through that reading, we hope you enjoy that. You can go to Amazon.com, BarnesandNoble.com, or Audible.com, download it or ship it to yourself today. Or if you'd like, we actually, for a limited time, providing a free signed copy. Send me an email directly at carljcox@40strategy.com to get that free signed copy. Well, with that, very excited to have our guest, Addison Adams. Addison is the founder of Adams Corporate Law. He's California's go-to voice on mergers and acquisitions. He is a lawyer that closes deals. He has effectively a corporate transaction boutique, handles buying and selling businesses, investor financing, partner buyouts, and material business agreements, including licensing and distribution agreements, as well as joint ventures. Addison, welcome to the Measure Success podcast.
Carl, it is a pleasure to be here. Thanks for having me.
Absolutely. So let's from your mindset, from your perspective, describe us in more detail about your business. What do you do, and how are you making a difference for your clients?
So I'm a lawyer that closes deals. We write contracts, we work on transactions, we negotiate the terms and conditions, and we help guide the client through the path of getting the goals that they want. They're trying to enter into either a sale of their business, or they're buying another company, or they're trying to do a joint venture, maybe set up a great, system or series of exclusive distribution relationships. All of these have a real business purpose. I'm there to help protect them, guide them, flag issues, paper the deal, get it signed so that they can make more money.
All right, so I'm curious, how in the heck did you get into this line of business?
Every lawyer, I think, finds themselves drawn to a different type of law. That's why there's so many different areas of law. And I started right out of law school. I got lucky. I got thrown into trials and litigation and depositions, and it was exciting and it was fun and it was just like on TV in many ways. But then I got an opportunity at a firm to work on private placements in the .com back when the internet was brand new. And so there was venture capital financing after, and I started working on those and became an expert in preferred equity and venture capital terms and conditions and all the protections that they have around voting and management and getting their preferred returns. And so I just fell in love with that and said, this is the direction I want to go. And that quickly turned into mergers and acquisitions and corporate deal making. And even though it's fun to slug it out in court, it's a lot more fun, I think, to have a closing dinner where everyone's just, celebrating. And it just draws me to it. I just like talking to the owner. I like talking to the CEO about something that is positive, where there's a win-win. For me at least, that is how I like spending my day. And I think it shows, if you do what you love, then it kind of comes through in every interaction that you have. So that's what gets me up in the morning, and that's what keeps me working so hard. I love it, and I'm good at it. You like what you're good at, so that's what I like to do. That's how I got into it.
We're currently working on a deal with one of our clients right now, and we're fortunate to have an experienced attorney who knows what they're doing. And it's remarkable of all the different pieces that somebody who's in the corporate world, meaning owns a business, they have no idea, right? And making sure that there's clean title and that the business are set up properly and that the terms and conditions are right. What biggest things that you typically see that's missed when a owner if you may. He's owned his business 5, 10, 15 years, and he's getting ready to sell it for the first time. When you come in and trying to help them out with that process, what are the biggest landmines that you typically run into?
I would say the number one thing is failure to be properly organized. You need to have not only the contract signed with your biggest customers, you need to be able to find it and find the signed version of it. And that might be hard. As far as the corporate formation documents go, usually there's going to be gaps there. Now that can be cleaned up, but there might be missing annual meetings. There might be just missing documents, meetings that should have happened that didn't happen, especially if you've got a complicated cap table. So a lot of the deals have a founder that is the sole owner. So in that case, there's not a lot, to worry about. But if you've had investors over the years, if you started the business with 3 partners and then you ended up buying the 2 of them out, you need to have all of that in paper, signed, dated, done, because you don't want the buyer, if you're assuming you're the seller, you don't want the buyer to have questions and get worried. Hey, is Bob that you bought out 10 years ago going to come around asking for $3 million, right? You've got to dot those I's. And so from a lawyer's point of view, that's just step one. Just you can kind of, with my help, or you can do a bit of a due diligence on yourself to go down the checklist of everything you should have. Step 2 would be to maybe do a little deeper dive into what makes your business special, what parts of it are valuable to a buyer, and what are more just sort of boilerplate normal type things. And so the valuable part, you want to make sure that you own it, that you've got the chain of title and everything I's are dotted, and that you have the right to sell it. So that gets really, obviously more important when you're an intellectual property based company. You've got software, patents, things like that. All that needs to be buttoned up, including everyone that worked on that software. You need to make sure you've got intellectual property assignments in the file where every developer signed it, confirming that the company owns it, has the right to sell it. Yeah, and then a lot of, like with your supplier agreements, sometimes there'll be non-assignment provisions where you need to go talk to the supplier before you have the right to assign it to the buyer. Usually, if you have a good buyer, you can get through that, but that can be a little bit of a delay. So being aware of what's in your contracts, certainly be careful about the contracts themselves, because you don't want to start peeling out things that would maybe adversely affect a buyer. For example, giving away exclusive territories is something to pay attention to. Promising, even like coexistence agreements on trademarks and covenants not to compete, those things all get inherited by a buyer. And so how will it affect them if it, assuming it applies to you and all your affiliates, that would include the buyer of your company. So kind of thinking a little bit long term, but that's like a second level of deep dive as far as getting legally ready to go. Step 1 is get organized, and hopefully, depending on how big your business is, you need to have good accounting, good financials. So that's a whole, because a lot of times that is what the driver is some multiple on EBITDA, which means you really need to know what your EBITDA is, and that'll save a lot of time if it's right, as opposed to, you thought it was right and it turns out it was way off.
Addison, I think this was a great job of sharing the risk, right? One of the key risks that a lot of owners don't recognize is like they've built a great business, but their corporate tracking is weak, right? And so when there's 2 ways of value you mentioned EBITDA. And for those who are new to this game, or EBITDA means earnings before interest, taxes, depreciation, and amortization. So that typically a business has a certain level of EBITDA. Let's say it's $1 million. And let's say, for argument's sake, there is a multiple on your industry, and let's say that's 5. So the baseline of your business is going to be 5 million, right? Once again, a $1 million EBITDA times the 5 multiple is $5 million. But the strength or the risk of your business is going to adjust that multiple. So, and what Addison's describing here is when the corporate transaction, it's a mess. When there isn't good documentation, where there isn't good contracts, it's going to actually decrease that multiple because it's higher risk. But when it's more put together, right, when legal documents are there, it's clean, you're going to actually end up getting a higher multiple as a result. And this is one of those like hidden gems, if you may, in terms of working with businesses to help increase that value. So, once again, I'm sure sometimes you get it brought in at the last minute, right, where it's like, okay, we're getting ready to sell. Do you ever get the opportunity, do you ever work with clients ahead of the game to say, hey, let's start preparing over the next year, right? So we can do this the right way.
Oh, sure. Yes, all the time. I'll get brought in. It's preparing ahead of time. There's kind of two sides to that. One of it is exactly what you think it is. It's going through, okay, snapshot today, looking backwards. If you were to sell today, are you ready? What do we need to do to get ready? But it also is on a go forward basis between then and closing. They need an outside attorney, a general counsel that can help make sure that all the new agreements that are getting signed are not problematic. And so it's a combination of making sure we've cleaned up, we've done a due diligence on ourselves, perhaps hired an accounting firm to run a sort of informal quality of earnings on ourselves to see if there's some changes that need to be made. There can also be advanced tax planning that happens. For example, if you're running in a C, let's say your business is a C corp, which is rarer and rarer to find these days. Usually it's an LLC, taxed as a partnership, or it's an S corp. If it is one of those, then you're looking good because you avoid the double tax on an asset sale. But if you're a C corp, then we might want to think about whether there's some things that could be done in advance that will minimize, your tax burden. Some of my clients even will do what I would call a more drastic remedy of if they're living in a high income tax state and they know they're going to sell their business in a few years, they might move. And, and actually move, not fake move, really move, so that they can get that lower income tax rate of the other state, and get it and then sell the business and, and have more money after tax. So that is obviously not for everybody. I certainly don't want to move, but if I wouldn't. But if it's a big enough number, then that could be pretty motivating too. It's also personal preference. Like some people really like to minimize their tax burden more than your average person does. So that's another thing. But yeah, so that's what we do to help prepare is run through a due diligence on the client, talk them through, and do some advanced planning. Yeah, like that. And also sometimes a person like yourself can come in because we might identify or mention that they should talk to an expert about identifying ways to increase their value. And that goes beyond the lawyer's advice, other than the tips and tricks I picked up along the way, talking to people like yourself, we'll say things like, we'll try to diversify your top 10 clients. So you don't have one doing 90% and the rest doing the 10%. Try to make, have a good team of second level executives around the owner. So it's not just 100% basically a one man show or one woman show. Things like that, right? And then also, do you have too many product SKUs? Should you focus on one? I'm getting into dangerous territory here as a lawyer, but these are great ways to, there's other things to do outside the legal world for sure to prepare for selling your business.
Yeah, and once again, you're hitting on these other strategies, right? There's you're mentioning there's the legal part, but there's other strategies in all of these. Once again, when you decrease the risk of your business, you increase the multiple likelihood, right? And once again, when you have higher risk, it's going to go down. Just like what you said there, if there's only one person running the company, or if you have one client that's 90%, you're going to have way less buyers, right? In that specific situation, unless it's a strategic buy, right? They want to actually sell to that client, as an example.
That's right. Just to comment on that, and I would say in addition to the multiple and getting the best purchase price, you also have this idea of not scaring off the buyer. So there's two things always happening in every sale of a business, right? One is the price, but the other is the go, no go decision that gets made, right? And so they want your business. They think they know what they're getting. But when you go through the due diligence process, that's why you're doing that. And so is to find out, is there going to be a surprise here? Do I trust the seller? And trust is hugely important. And the idea that when you're asking questions, are you getting truthful answers? Is there a sense that the seller is trying to pull a fast one, trying to get away with something? So there's that on an integrity level question. But related to it is the seller knowledgeable and even know the answer? Or are they just giving wrong answers because they're uninformed? They don't really know what their cost of goods sold is. They just think they do. Just there's a million ways that, to make a mistake and lose credibility. So you need to have credibility both, and I highly recommend transparency. Don't try to pull a fast one. because that's how you end up having problems after the sale. Even if they don't find it, that's how you get sued, is if you try to get away with something. Much better to just be open about things and then fix them. Obviously, if we can fix them before we have to share it with the buyer, even better. And then we just explain, here was the fix, right? But yeah, so you need to know what you're talking about. And you also need to tell the truth. And you need to look at it, I think, from a point of view of, this is a win-win. I have something valuable. I'm selling it to someone who's going to take it and make it even more valuable. I'm only selling because it's the right time for me to sell. And the buyer's only buying because they've decided they want this and it's the right time for them to buy. And the danger, I would say, of trying to hide something is if you get caught, the whole deal can just be called off because they don't trust anything that you say. So that's my advice to all potential sellers out there is, get organized and just get it out there.
Agree. I think really good advice you're saying there. And there's something else I want to talk about it's one of those dirty hidden secrets that isn't talked about a lot in mergers and acquisitions, which is the concept of an earnout. And I want you to explain it here in a moment from a legal perspective and the challenges that happen with an earnout. But just from a basic standpoint, from my perspective, somebody might buy a business, once again, using that same thing, $1 million EBITDA, 5 multiple. Let's assume they get it exactly. Everyone agrees to that $5 million purchase price. And that might even be in a press release. Hey, we bought this business for $5 million, but what they might not tell you, there's an earnout. And there might be $1 million earnout, which might mean that there's $4 million going to the sellers, but $1 million being held back as a result of future things that still have to be proven out to earn the rest of that million. So from a legal perspective, Addison, if you could provide a little bit more color around that and some of the challenges you typically see on whether or not an earnout was hit.
Sure, absolutely. And another great question. Earnouts are both the best thing in the world and the worst thing in the world. They are sometimes a necessity in order to get the deal done because there's a mismatch on price. The seller says, I want $5 million. The buyer says, well, I'm only comfortable paying $4 million, but if the business is what I think it is and performs as projected, okay, I'll pay $5 million, right? That's the basic idea of an earnout. From the seller's point of view, you'd rather not have any risk. You just want the $5 million at close, no earnout. And this gets obviously more exciting when you have bigger numbers, 50 million and the earnout's another 10, just as an example. Most of the litigation that you see on, after closing a sale of a business relates to disputes over earnouts. Was it hit? Was it not hit? We all agree it wasn't hit. Whose fault was it that it wasn't hit? And the whose fault was it is the biggest risk of an earnout, because when you sell your business, you lose control. It's no longer your business. So then you say, well, why is my pay dependent on how they run my former business? That seems not fair. That seems risky. And it is risky. 100% right. So there's this question, this concern, and it usually doesn't bear out as, fearfully as badly as you might suspect. We do close deals all the time with earnouts, and they typically get hit and they're fine, right? So it works. It's not like it always fails. But, so what are some of the things that we talk about with the buyers? We talk about basically two things. One is the concept of control and decision making. This idea of, well, the business needs to have our team. I've got the best employees in the world. If you fire them all, of course, we're not going to hit the earnout. So we need to talk about employee retention and, and authority. We spend, this is how we market for new business. How are you going to market for new business? Are you going to cut the budget? You're going to keep it flat? You're going to increase it? You've got kind of these ideas of status quo. Is the business that you're selling going to continue moving on as it has, or in some better way as opposed to some worse way? And typically buyers will agree to some language, usually in a soft kind of language, manner, but to not make things worse, right? And that would be obviously good faith anyways. Then you've got the second side of it, which is the concept of when buyers buy businesses, they integrate them into their business typically. Not always, but usually. They integrate them in and they try to get economies of scale. Some jobs might get eliminated, or they have their own policies and processes, which are good. And so in that, though, becomes a question of, well, are we properly tracking the target earnout numbers. If it's a revenue number or it's a profit number, how is that now getting sort of adjusted with the other revenues and other expenses of the business? Meaning, are we getting burdened with some share of the parent company overhead? How is that getting allocated to our business if it's a profit number? Is our revenue somehow going to be diverted to other departments in the buyer? So those are accounting questions or practical questions. And it's kind of a commingling question about how are we going to, are we going to remain a separate entity, a wholly owned subsidiary of the buyer with separate bank accounts and separate books? Of course, that's the best for the earnout period. Earnout period is usually 1, 2, or 3 years, right? So it's not forever. It's has a finite time. And so those are some of the thoughts to think about as far as negotiating the earnout, and how you could end up having a disagreement about if you don't make the earnout. Obviously, if you make the earnout, there's nothing to fight over. You get paid your money, so you don't make the earnout, you don't get paid your money. And then you feel like, well, was that fair? My business didn't perform as expected, or did my sort of leg get cut out from under me because, the buyer did or failed to do something that I told them to do, or I would have done if I would have been there, or they just, money got commingled and it's hard to know whose profit that dollar was, and that can be tough, especially when you have overlapping clients between the buyer and seller before the deal closes. So yeah, I mean, this is, there's books on earnouts, right? We could spend hours on just talking about how to structure different formulas and different ways to do earnouts. I will say, just as just backing up, an earnout is not the same as a deferred purchase price, which is essentially seller financing. And it's not the same as an indemnity holdback. The effect of an indemnity holdback or an indemnity escrow might be, say, well, we don't know if there's going to be unknown liabilities, debts pop up, lawsuits get filed. So we're just going to take $1 million or whatever the number is, and we're going to either put it in a third-party escrow for a year or 2 years. And if there's no claims, we'll give you the money. Or we'll just not put it in escrow and not pay you. We'll just promise to pay you in a year or two. And but only if there's no claims, so that way, if there are claims, we'll just offset it against that money, and so that is not an earnout. That's an indemnity escrow or indemnity holdback, which is one of the things that the seller would like to, we always try to negotiate that from the buyer's point of view. You'd like to have a giant number for as long as possible. The seller's point of view, you want a small number for as short as possible. And so you try to meet somewhere in the middle. And we've got all kinds of statistics, across thousands of deals as far as percentage of purchase price and the low and the high and the length of term, which is, usually in the 5 to 15% range, usually between 6 months and 2.5 years. So sweet spot is going to be 10% holdback for 12 or 18 months. Or escrow, either way, indemnity escrow. It used to be all escrows. Now it seems to be all holdbacks happening. So I guess people got tired of paying the escrow fees and dealing with the interest and things like that. Plus, you're out of the money as the buyer. The holdback is always fine unless the buyer is in any way a credit risk. And so, I would be careful if you have a buyer that's heavily leveraged, right? You want to think twice about seller financing and any kind of holdback versus an escrow. Because I have seen situations, I'm dealing with a situation right now, 2 years after the sale, the buyer is late on making their second year's payment. And so my client surprised because normally the buyers are strong credit, but anything can happen out there. So you got to be careful.
Yeah. And so I think what's super important for people who are listening here is there is a lot of nuances when you're going through getting ready to sell or getting ready to buy. And you want to make sure you have something like Addison on your side to go through these details, because it can cost you hundreds of thousands, millions of dollars, tens of millions of dollars, depending on the size of the agreement. And this is, I think, one of the problems now is like people go, oh, I'll just work with my buddy down the road who happens to be an attorney, or we'll just go online and look something up. It is way more complex and there's way more challenges, especially if the adversary has more savvy attorneys than you do. Once again, you're at significant risk, right, of losing things along the way. Now, Addison, there's something new that's come out this year, and I think it's the end of, meaning in 2024, and small to medium-sized businesses are at risk of significant penalties and fines if they don't sign up for the Corporate Transparency Act. Can you give a brief definition of what the Corporate Transparency Act and a brief understanding of what type of penalties are there if you don't properly file for this?
Sure. So this is a big deal if it applies to you as a business owner. The idea is it's started under the Financial Crime Enforcement Federal, FinCEN, has put in this to avoid and limit money laundering. This is where it comes from. It's trying to prevent criminals from using shell companies to hide illegal money getting moved around, terrorist money, mafia money, any kind of crime, drug money, all that stuff has been hidden behind this network of, shell companies, offshore companies as well as onshore. And so the law says if you have a shell company or anything that's, small enough, you're required to make a filing with this brand new private law enforcement database. It's called a beneficial ownership filing. And what it says is you have to disclose who the owners are, who the major owners are, and also who's in charge of it. So that would include the officers, the CEO, the directors. It also includes if there is one, the person that's trying not to be disclosed, the actual criminal that's like telling everyone what to do. That person has to be disclosed. And by disclosed, it's no joke. You have to disclose name, birth date, copy of your passport, home address, as personal gets, as far as who you are and your identity is in this database, which is why thankfully it's not a publicly available database, at least at this time. It's not ever supposed to be. It's for the FBI. It's for law enforcement people that have a reason to look in there. But you have to do it, and so that's a big change. That's new, and the law just started January 1. So for all the existing corporations, LLCs, limited partnerships, everyone has to file. You've got a grace period of 1 year, so you've got till the end of this calendar year to make that filing for all of your owners. That apply. Now there's exemptions. There's 23 exemptions. One of the bigger exemptions is called the large operating company exemption. And so if your company is a large operating company, then you do not have to make any kind of filing for all of the owners. So what is a large operating company defined as? You need to have a physical office in the US. Okay. So it can't be just a post drop or something like that. You got to actually have an office with people. You have to have at least 20 full-time people working in the US. So overseas doesn't count. 20 people or more here. And you have to file a tax return showing over $5 million in revenue for the entity. And so if you miss one of those, then you have to file. But if you have all three, then you don't have to file and you're fine. So that's going to wrap up most companies, are going to qualify, most middle market and up, of course, is all going to be exempt from this. But the startup companies, the small mom and pop companies are going to have to do this filing. And of course, the ones they really want are the shell companies where you got one person and they've got 5 different companies and everything's getting moved around. So by the way, there are good reasons to have shell companies. In fact, I help clients set them up all the time. And there are good reasons to have a level of public anonymity. And I help clients do that too. If you're a celebrity, for example, or you're just a notable person, or you just really like your privacy, even if you're in an industry that can generate a lot of litigation and you're tired of getting sued personally because, the business is doing something. And so the idea of being anonymous to the public is okay. Obviously, being anonymous to the tax authorities and the legal authorities, not okay. So, but there is a way to thread that needle where you're paying your taxes, you're filing all the obligations, the state that you're in knows who you are, the bank you're dealing with knows who you are, but you're avoiding a public document that says, oh yeah, I'm that person. So this FinCEN Corporate Transparency Act is one more tool for regulators and for law enforcement to go after the bad guys, which is good because all of us are trying to do it right and follow the rules, and we want everyone else to also.
Yeah, and so thank you, Addison, for providing details on this. And whether or not you are concerned about this or not, look into it. And there are significant penalties and fines. Once again, if you have small to medium-sized businesses or you have these different entities, and if it's not properly filed, this is your warning, folks. Go out and make sure you get your filing completed by the end of 2018. 2024.
I failed to answer your question about the penalties, so let me let me mention that. And for any, by the way, for any new company that gets formed, and we've already formed a few already this year, you've got only 90 days to get that filing done. So the new stuff, 90 days. The old stuff, you got till the end of the year. And if you don't make the filing, then there's a $500 a day is the initial penalty. And if you're using it to commit a crime, then the penalty can go up to $100,000. And if the crime is a felony, it can go up to $500,000. Failing to file, if you have to file and you don't have an exemption, is a crime. And so there is prison time as well. Under the worst, with the exacerbating circumstances, it's up to 10 years in prison. So this is, you got to take it seriously. Is the short answer.
Yeah, no, thank you, and thanks for adding those penalties because they're severe. I mean, these are really severe. I mean, $500 a day, right? It's not okay, right, to be late on something like this. But even the worst is that this is potential jail time for people. This is putting a whole new part on. Well, get it done. That's all I say is get it done. If you're doing the right thing, get it done. Avoid the penalties. And Addison, I appreciate you providing more detail. All right, we just got a few minutes left, so we're going to go quickly on the last set of questions here, Addison. How do you measure success in your business?
Client satisfaction. It's easy to talk about financial success and a rewarding, I guess, lifestyle balance, things like that. But for me, what drives me, I think what drives every attorney at our firm, what we thrive on is happy clients, and there's just nothing better than hearing a thank you, especially a deep, gratitude. Thank you so much. This was overwhelming. This was such a big deal for me. This was my business for 40 years. It's my life. That's how I measure success.
That's awesome. All right, Addison, I love to talk with our high achievers about how they personally do success. What's a habit or two that you do consistently to help make sure you're performing at your best?
Oh, so gosh, I guess health is, you can't underestimate how important your health is. So it's good sleep, good health, healthy eating and exercise. That's top for me. Staying engaged, working hard. When as far as success goes, there's just no other way to say it. Working hard. And then as far as being a good, organizer or running a good entity, a good company, surrounding yourself with the best, hiring the best people. And then, that magic word, delegating, that is so important, right? Because all of us successful people are good at what we do. And we know that we'll do a great job, but if we try to do everything, then we'll never do more than just what we can do ourselves. So you've got to learn to have a team and take advantage of them. Those are my habits for sure.
I love that last point that you made there, delegation. It's one of the big challenges of entrepreneurs, right? And anybody, in especially professional trades, where they are the best of the best at what they do. They might be the best person in the company, but once again, you will be limited in your scale, right? If you don't find a way to train it, offshore it, outsource it, hire right people. And then when we really figure it out, often we find out there are actually somebody who's better than us, right? And having that humility, right? That others around can actually help us out, provide more value, and ideally we can learn from them, right? If you hire other superstars around you. So, what is a book that has inspired you that you'd recommend for our audience?
Oh gosh, a book that inspired me was. I'm going to just go with the old Stand By Atlas Shrugged by Ayn Rand. That one, for some reason, it did affect me, even though I read it decades ago. It gave me a different perspective on things.
It is. It's a classic. It's meaty one, but it is a classic. If you have go through it, it really opens your eyes, right? And the way how decision making is done, and the way to think differently. I think is a wonderful thing about Atlas Shrugged. There's more to it. I'm just like scratching the surface in that particular book.
I think that there's two layers to that book. First, there's all the messaging that it's trying to give us about hard work and successful people and the idea of equality and inequality and all those things. But then after you've read it and after I've read it and then come back and start challenging some of its premises and questioning them, I just felt like it was a great, I guess, a mind-opening book for me to help with the intellectual journey about the economy, about life, about success, measuring success, all of these things, and what individuals bring in terms of value to the table.
Addison, how can people connect with you and learn more about your organization?
So you can find me personally on LinkedIn at the LinkedIn website /and/Addison Adams. So real simple there. I have a company law firm website that's adamscorporatelaw.com. You can also give me a phone call. That's 714-619-9360. You're welcome to shoot me an email at addison@adamscorporatelaw.com. And Addison is spelled Addison. And I'd be happy to talk with anyone. Love to help at any time.
Hey, I appreciate that. And for you even providing your number and people be able to connect, I think it's very generous. So thank you for doing that. Addison, thank you so much for being a guest on the Measure Success podcast today.
Carl, I love your podcast and I really enjoy getting to know you better. Thank you so much for having me here today.
Absolutely. And to everyone else who's listening, once again, we just appreciate what you do being guests in our growing community podcast, and we hope it continues to make a difference for you. Love you to continue to give us reviews. That's how once we grow and people know more about it, so we can get great guests like Addison to help you with what you do. As we always like to say, wishing you the very best at measuring your success. Have a great day.
Thanks for listening to the Measure Success podcast. We'll see you again next time to learn from the best. Remember to subscribe now to get future episodes.